Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. The S&P 500 has been rallying very violently here over the past couple of trading sessions after having hit an oversold RSI reading, briefly undercutting the June low here. The market seems to be snapping back above, potentially marking a successful retest of the June low. If we see a powerful recovery here, that would be considered a successful retest. So in this video, we're going to discuss why has this been happening? Is this just a technical bounce after an oversold RSI reading, or is there actually a fundamental driving factor behind this move? And more importantly, of course, should we expect it to last more than just a couple of trading sessions? That's exactly what we are going to cover in this episode. If you are new here, don't forget to smash that subscribe button as hard as you can if you want to follow these crazy markets with us. You want to stay up to date on what's going on, make sure to hit that subscribe button. And if you enjoy this episode, smash that like button as hard as you can. It makes a big difference to our channel, so it is really appreciated. Now, without further ado, let's get right into it. So let's first go back to the primary driving factor behind the market right now, and that is bond yields. Right? Let's put up the 10-year yield, for example. Big Fed-induced rise in rates right here that caused initial part of the correction in the first half of 2022. And then this correction right here that we got in August has also been a direct result of the tightening of monetary policy, so reflected in rising bond yields such as the 10-year yield. That's a great proxy for market valuations. Now, yields are a market-driven rate, right? So that means that they pay attention to what the Fed is saying, but they also try and anticipate what the Fed's going to do. It's the 10-year yield, so it's based on the expectations looking out 10 years. And so it also looks at economic growth, at long-term inflation expectations. And so if we briefly take a look at what happened right here that created that little drop in yields, because you can see this is what has been driving the market. This has been driving the correction, the upside in yields, and the reversal in the 10-year has triggered this bounce so far on the S&P 500. Why did that happen? Why did we see this reversal? There's a few reasons for that, and we're going to take a look at that right now. Well, believe it or not, it's because the manufacturing PMI came in below expectations. So on Monday at market open, we had the manufacturing PMI, which is basically a representation of economic activity and what a lot of manufacturing companies in the private sector, how they're feeling about business conditions, and it came in at 50.9%. That was below what a lot of people were expecting. And so if we take a look at what was happening on the 10-year as that was released, it got released right here. And so the 10-year broke down. You're probably wondering, this is completely ridiculous. We got a below than expected PMI reading, so that's telling you that economic activity is deteriorating, it's going down, and yet that's having a positive effect on the market. Lower yields are bringing the market higher. That doesn't make sense, and you're completely right. The market doesn't always make sense, but this is definitely not the first time we're seeing this. It's a bad news is good news environment. So when you have bad news, it means that financial conditions are going to get easier, and that's generally a good thing for stocks. It's not always good to have a very hot economy. That's not always a good thing because you get rising interest rates, monetary policy needs to tighten, and that's generally bad for investing in assets. So when you see economic numbers cool down, it's telling you that there's more chance that you're going to get easier financial conditions. That's going to be good for the stock market that directly prices in a higher valuation, right? And let me quickly show you what happened in 2019, for example, as you had this move down in the 10-year yield, a big decline in yields. Well, you saw the stock market rise significantly as a result because you had the discount rate moving down, and so valuations could start to trend higher, and that's exactly what happened in 2019. We believe that's the environment that we're currently in. Bad news is good news when it comes to the economy. Of course, seeing inflation come down, that's good news. And that's going to make yields come down more violently. If you see good news from an economic standpoint, well, that's going to be bad news for the stock market. You're going to see yields rise and continue to put pressure on stocks. Now, of course, that doesn't tell us whether that's actually going to materialize into a larger move. Let's discuss that and try to do the best we can to figure it out. Before we dive into that, don't forget to take a couple of seconds to smash that like button as hard as you can. We really work hard on these videos to try and give you guys the best research, the best opinion on the market. Of course, we're not going to get everything right, but at the end of the day, that is our goal, is to help you guys as much as possible. So if you enjoy what we provide and you want to support the channel, don't forget to hit that like button. It is really appreciated. So let's quickly take a look at the S&P 500 update that we posted on Friday of last week, because there are a few charts that are still very relevant today. Now, first of all, market breadth, very, very oversold right there on Friday. It doesn't look like much, right? It doesn't look like this is very important, but this is the percentage of stocks above their 50-day moving average. We talked about it a few times here, and you really just don't get these readings very often. And when you do, it's often near a significant low. Now, of course, in October of 2008, you had this reading and the market continued to collapse. That's something to keep in mind, but we were testing the 200-day moving average, and J&K, so high yield bonds, you can see here in black, were anticipating a reversal. So you can see here, let me zoom in a little bit here, high yield turning up and the market continuing to move down. It's very subtle, right? This is the type of thing that we're watching every day for, to see if there's actually a sign of an imminent reversal. Even though our real investment outlook is 6 to 12 months, we do pay attention to these types of signals that can time tops and bottoms beautifully, and that's been the case throughout 2022. For example, these bottoms right here both showed divergences, with high yield that was anticipating the bottom, and the tops in August and in May both showed bearish divergences, with J&K anticipating a reversal. This was the corporate bond market telling you that a bottom was coming in. Now, you can see every time we've had that, we had a pretty powerful reversal. Not necessarily a massive recovery, but it tells you there's a short-term reversal coming. At least this time around, it did seem to be another successful signal, and the VIX was making a false breakout here. So the market was setting up for a rally, but if we move down here, you can see bond yields had not broken down yet. And so, to us, the big signal back in June, right, was the breakdown in government bond yields right here. That was an early confirmation that bond yields were reversing and the market would have had higher, at least in the intermediate term. And so this is what we were showing on this chart. And you can see we got the breakdown, as we said a couple of minutes ago, we got the PMI release that really broke down structure so far. And so that's pushing the market higher. If you're not convinced by that, and I know there are some people in the comments that don't seem to be very convinced by that, but I think if you're not paying attention to bond yields, you're really missing a big part of the picture. And you can see right here, we kind of had the exact same setup where bond yields peaked, the market made a lower low after that and went on higher, and bond yields broke down, retested, rejected. Here, bond yields peaked, market made a lower low. Now yields have broken down. We'll see if we get a retest and a rejection. Right, if we do, that signals, and potentially a lot larger than the one we got in August. And I know I'm going to get a lot of heat in the comment section for that, and that's okay. You guys are entitled to your own opinion and to criticize my opinion, as long as it's done in a polite and respectful manner. But if we jump over to our Twitter account at GameOfTrades_, you can see we retweeted this article here. UN calls on Fed, other central banks to halt interest rate increases. This by itself doesn't mean much, but you can see there's an increasing amount of pressure that's really telling the Fed, okay, you guys have been very aggressive, very tight. You showed everyone that you're very tough on inflation, and that's great, but be careful. In this article, they actually talked about a global economic downturn, right? And that could very well happen. And in this article, they talked about the risk of a global economic downturn. So, that's obviously the type of thing that the Fed doesn't want to be known for, right? They got a lot of heat for not taking inflation seriously. They don't want to also have the reputation of having triggered a global economic downturn, which could already be the case. And we're going to talk about that in just a second, that it might already be too late for the Fed to step away from the brakes. And you can see there's also some pressure from the UK that's really starting to pivot. That's really not the type of thing that we heard back in June and July, right? This could actually trigger a more meaningful reversal in the 10-year yield and keep it lower, right? And remove that pressure on valuations that have been just aggressively pulling the market down for months now. If that does happen, you should expect the market to perform very well as it starts to actually look forward to the recovery, right? Now, will that recovery actually materialize? That's another question. In 2008, it didn't materialize, and so you had the global financial crisis that brought the market down 60%. But you can see what was happening here in 2006, 2007. The market was pricing in the recovery after the tightening cycle was done. Tightening cycle was behind us, and investors started to price in a recovery in economic activity, not a global financial crisis. Of course, they ended up being wrong. And, that could very well happen again. So we're going to be watching this very carefully at gameoftrades.net. We're going to be watching bond yields. Potentially, if they retest, if they snap back above, that would be bad news. A market rally now assumes that you're going to get a straight leg down. That could very well happen in our 6 to 12 month investment horizon. And based on the research that we've done on the 6 to 12 month investment horizon, you can check the various articles we have on gameoftrades.net that we've done on this. But we think yields have limited upside and they have a lot of room to stabilize. But of course, a lot of people have been very early on this trade, especially ever since we got that breakdown in the relationship between oil and yields that were moving together, right? And the market was basically pricing in oil, and yields just went off on their own direction. Now, potentially, they're snapping back and coming back to reality, but I don't have a crystal ball, right? I don't know if it's going to be a straight leg down, if it's going to be a zigzag topping pattern. It could still last a couple of months, but we are watching all of these developments in detail, reassessing the macro every single week. And of course, we're going to be reassessing whether we think stocks are going to continue to respond favorably to this type of breakdown in yields. But I think we're going to start to shift our primary focus on the market to earnings. It's been very much about the Fed and yields. Our bet is that the reversal in yields, and potentially a little bit later on in a couple of months, maybe in November, December, we get some type of a Fed pivot. I think by the time that actually happens, the market will be well off their lows. But as time goes on, you're going to see the rate shock that we got this year. This is a 1-year yield, massive rise in rates that's going to start funneling into earnings, right? Just like it did in 2008 and 2000 and 1990, right? Rate shocks end up damaging consumer spending, and they end up damaging S&P 500 earnings, which can create a bear market. It's only a matter of time before that happens. And so as we see this market rally, if we see this market rally throughout the next few months and the market gets more expensive, potentially hitting our target at 5,200 points, the risk of earnings surprising to the downside and pulling the market into a new bear market, those risks increase substantially. So of course, if you are interested in following our take on the market, following the opportunities that we highlight, following how we're currently thinking about our positioning in this environment, make sure to click on the link down below to take a look at our service at gameoftrades.net. There is a 7-day free trial, so there really is no reason not to test it out. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button and hit that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.